Have you ever noticed how most people work harder and harder every single year, yet financially they still feel like they're standing in the same place? It's not because they are lazy, and it's not because they don't earn enough. The real reason starts much earlier, deep inside a belief almost everyone carries without questioning it: the fear of debt. From a young age, people are told that debt is dangerous, that loans destroy lives, that borrowing money is something only irresponsible people do. So naturally, most individuals build their entire financial behavior around avoiding it completely. But here is the uncomfortable truth nobody explains clearly. Fear of debt does not automatically create wealth. In fact, for many people, it quietly becomes the reason they never scale beyond their salary. While they focus only on saving and avoiding risk, the financial system continues moving forward. Prices rise, opportunities grow, assets appreciate, and those who understand how to use financial tools move ahead while others stay cautious. Believing caution alone is enough to win the game. This is where everything begins to split into two directions: those who fear financial tools and those who learn to understand them. One avoids risk entirely and feels safe but remains limited. The other learns structure, studies leverage, and begins to see money differently, not as something to protect only, but something that could be directed. If this idea is already making you rethink what you were taught about money, take a moment to subscribe, like this video, and comment below where you stand right now: fear or understanding. Because what comes next will challenge everything you think you know about debt, banks, and financial freedom. Most people grow up hearing the same advice repeated so often that it becomes almost invisible. Never borrow money, avoid loans, stay away from debt. On the surface, this sounds like wisdom. It feels safe, responsible, even mature. But very few people ever stop to question whether avoiding debt completely actually creates wealth or simply creates comfort that slowly loses value over time. Because while individuals are taught to fear borrowing, the entire financial system around them is built on it. Governments borrow to fund infrastructure. Corporations use debt to expand globally. Banks lend money as their core business model. Even large investors use leverage to multiply returns. So the question becomes uncomfortable but necessary. If debt is always bad, why does the most powerful part of the economy rely on it so heavily? The answer is not that debt is good or bad. It is that debt is a tool, and like any tool, its outcome depends entirely on how it is used. When most people think about borrowing, they think about consumption: a car, a phone, a vacation, or lifestyle upgrades that don't generate income. In that case, debt becomes a burden because money flows out with no return. But there is another form of borrowing that almost nobody is taught early in life: borrowing for acquisition. That is when capital is used to control something that produces income over time. The same loan structure, but a completely different financial outcome. Imagine two people earning the same salary. One avoids all debt and slowly saves for years. The other studies how assets work and uses structured borrowing to acquire something that generates monthly income. Years later, the first person has security but limited growth, while the second has systems working in the background. The difference was never income. It was understanding how money can be deployed, not just stored. This is the point where most people either become curious or defensive. Because if debt is not purely dangerous, then the real question becomes, do I understand it well enough to use it? Or am I avoiding it because I was never taught how it actually works? And that shift in thinking is where financial growth either begins or stops completely. Most people assume banks make money in a complicated, almost mysterious way that only financial experts can fully understand. But the truth is far simpler, and once you see it clearly, it changes how you view the entire financial system. Banks are not unpredictable. They are structured, calculated, and built on one core principle: risk management. Their entire business model revolves around lending money and earning a return through interest, while carefully controlling the probability of loss. When a bank gives a loan, it is not taking a blind gamble. It evaluates patterns, data, credit behavior, income stability, and repayment history. Over time, This creates a system where a large number of small, predictable profits from interest payments outweigh the occasional losses from defaults. That is how the system remains stable. It does not rely on perfection. It relies on scale and predictability. Here is where it becomes interesting. The bank is not emotionally attached to what you buy with the loan. Whether someone finances a luxury car, a business expansion, or a small property, the bank's concern is not the purpose. It is the likelihood of repayment. This is why two people can walk into the same bank, borrow similar amounts, and walk out with completely different financial futures. Not because the bank changed, but because their intentions and structures differ. One person may use debt to consume. The other may use debt to acquire assets that generate income. From the bank's perspective, both are just borrowers. But from a wealth perspective, one is exchanging future labor for present consumption, while the other is using capital to create additional capital. The difference is not visible immediately, but it compounds over time in completely different directions. This is why understanding the system matters more than judging it. Banks are not designed to make you rich or poor. They're designed to stay profitable. Your financial outcome depends on how you interact with that system. If you use it emotionally, it works against you. If you use it strategically, it can become a powerful tool. And this is the first real shift in thinking. The financial system does not change for individuals, but individuals can change how they position themselves within it. Most people live inside the financial system without ever realizing there are completely different ways of thinking within it. On the surface, everyone appears similar. They earn money, pay bills, maybe save a little, and occasionally use credit. But underneath that surface, there are actually distinct financial mindsets that determine whether a person stays stuck or gradually moves toward wealth. The first mindset is the consumer mindset. This is where most people operate. The focus here is simple. Income comes in, expenses go out, and any remaining money is either spent or saved cautiously. When borrowing enters the picture, it is usually for consumption, things that provide short-term satisfaction but do not generate income. This mindset is driven by security and immediate comfort. It avoids risk, but it also avoids leverage, which means growth remains slow and dependent entirely on labor. The second mindset is the cautious saver. This person avoids debt almost entirely. They believe financial safety comes from eliminating risk, staying debt-free, and slowly accumulating money over time. On the surface, this seems disciplined, and in some ways, it is more stable than the consumer mindset. But it still has a limitation. It relies heavily on time and income from work. Wealth grows, but very slowly because capital is not actively deployed. Then there's a third mindset, the strategic builder. This is where financial thinking changes completely. Instead of asking, how do I avoid debt? This mindset asks, how can I use financial tools to create more output than input? Here, borrowing is not emotional. It is structured. Capital is used to acquire assets, build systems, or expand income streams. Debt is not feared. It is evaluated. Risk is not avoided. It is managed. What separates these mindsets is not intelligence, but perception. One sees debt as danger. Another sees it as unnecessary. The third sees it as a tool that must be understood before it is used. Over time, these differences compound into completely different financial realities, even if all three people started from the same income level. And this is where the real transformation begins, not in how much you earn, but in how you think about money before you ever make a financial decision. If you observe people over a long enough timeline, you start to notice something uncomfortable but very real. Income alone does not determine financial success. There are people earning high salaries who remain financially stressed, and others with moderate income who gradually build real wealth. The difference is not the amount of money coming in, it is how that money is understood and deployed. The wealthy do not necessarily reject debt. Instead, they question it. They don't ask whether borrowing is good or bad in general. They ask what role it plays in a specific situation. This is a completely different way of thinking. To them, money is not just something to earn and spend. It is something that can be structured, multiplied, and redirected. And debt becomes one of the tools that can either accelerate or destroy that process, depending on how it is used. Most people assume the goal is to eliminate debt as quickly as possible. But the wealthier mindset sees a deeper distinction. There is debt that drains you and debt that builds you. Draining debt is tied to consumption, things that lose value and produce no return. Building debt is tied to acquisition, assets or systems that generate income over time. The key difference is not the loan itself, but what it is attached to. This is why two people can use the same financial product and end up in completely different positions years later. One person uses credit to finance lifestyle upgrades, slowly increasing monthly obligations without increasing income. The other uses structured borrowing to acquire something that produces cash flow, slowly reducing dependency on their job. On paper, both have debt. In reality, one is shrinking financially while the other is expanding. The wealthy understand something most people miss. Money is not just about accumulation, it is about direction. If money moves only outward, toward expenses, it creates pressure. If it is directed into assets that return more money, it creates expansion. That shift in direction is what separates financial survival from financial growth. And once you start seeing money this way, the question is no longer should I avoid debt, but rather, does this decision move me toward independence or dependence? That single question quietly changes everything. If you've ever felt uncomfortable just hearing the word debt, you're not alone. Most people are conditioned to see debt as danger, something to avoid at all costs. But here's the uncomfortable truth that separates wealth builders from everyone else. Debt itself is not the problem. Ignorance is. The wealthy don't ask, how do I avoid debt? They ask, what kind of debt improves my position? This shift changes everything. Because when you understand how money actually moves in the system, debt becomes less about fear and more about structure. Imagine two people. One avoids all borrowing and slowly builds wealth through savings alone. The other uses fixed, controlled debt to acquire income-producing assets. Over time, inflation erodes the first person's buying power, while the second grows equity and cash flow simultaneously. Same economy, different positioning. That's why understanding leverage is not optional anymore. It's survival in a system where currency constantly loses value. But here's the reframe. Debt only works in your favor when it is tied to assets that either appreciate or produce income consistently. If it funds consumption, it becomes a trap. If it funds production, it becomes acceleration. So the question is never, should I avoid debt? The real question is, does this debt make me stronger financially or weaker? That one question alone can reshape your entire financial future. And if you're serious about mastering money, don't just watch, subscribe, stay consistent with these lessons, and comment what part of this mindset shift hit you the hardest. Because the next layer we go into will completely change how you see banks, borrowing, and control over money. Most people think inflation is something that happens to them, like bad weather, unpredictable, unavoidable, and unfair. But in reality, inflation is a transfer mechanism. It quietly moves wealth from people who hold cash and fixed income into people who hold assets and control leverage. The system doesn't collapse your money overnight. It slowly reduces what your money can buy. That's why sitting in cash for too long feels safe, but quietly becomes expensive over time. Now compare two individuals in the same economy. One keeps everything in savings, hoping stability equals security. The other understands that currency is designed to lose purchasing power, so they position themselves in assets that adjust with inflation. Real estate, businesses with pricing power, and income streams that grow over time. When prices rise, the first person feels pressure everywhere. Rent, groceries, fuel. The second person experiences something different. His costs may rise, but so does his income and asset value. That gap is where wealth is created. Inflation is not just a financial concept. It's a positioning test. Are you holding things that decay in value or things that expand with the system itself? This is why fixed-rate debt becomes powerful in inflationary environments. Your repayment stays constant while the value of money decreases and asset prices rise. It's not about taking reckless risk. It's about aligning structure with economic reality. The mistake most people make is emotional. They react to inflation by becoming defensive, cutting exposure, and avoiding growth. But the wealthy respond strategically. They adjust positioning, not emotion. If you understand this shift, you stop fearing inflation and start using it as a backdrop for expansion. And if this idea is reshaping how you think about money already, make sure you're subscribed and following through every section, because this is where financial thinking starts separating into two completely different worlds: reaction versus strategy. Most people believe debt is dangerous because they've only ever seen it used in the wrong way. Credit cards, consumer loans, and emotional spending that creates stress instead of structure. But debt in itself is neutral. It behaves exactly like fire, destructive in the wrong hands, transformative in the right ones. The difference is not the tool, but the user. Now imagine two individuals again. One uses debt to buy liabilities, things that drain cash every month like cars, gadgets, or lifestyle upgrades. The other uses debt to acquire income-producing assets, property that generates rent, businesses that create cash flow, or investments that compound over time. On paper, both have debt, but in reality, one is moving toward financial pressure while the other is building financial control. The real danger is not borrowing. It is borrowing without a return structure. Because when debt is tied to assets that don't produce income, every interest payment becomes a burden. But when debt is tied to productive systems, it becomes a multiplier. This is why wealthy individuals don't ask, "How much can I borrow?" They ask, "What can this borrowed capital produce?" That shift turns debt from liability into leverage. And leverage, when controlled, allows you to control more assets than your personal capital would ever allow. But there is a hidden discipline here. Timing and structure matter more than ambition. Fixed-rate borrowing in unstable environments can act as protection, while variable debt in volatile cycles can destroy margins quickly. This is why financial maturity is not about avoiding debt. It's about mastering its structure. Because once you understand how money behaves under different conditions, you stop fearing debt and start designing it intentionally. If this is starting to reshape how you think about borrowing, stay consistent with these lessons, subscribe, and keep following through. Because what comes next is where we break down how banks actually decide who gets access to capital and who doesn't. If you look closely at how wealth is actually built, it's never just about income. It's about spread. Spread between what money costs you and what it earns for you. This is where most people miss the entire game. They focus on how much they make, not how efficiently their money works. But the wealthy obsess over one thing: the gap between cost of capital and return on capital. That gap is where leverage becomes powerful. Now imagine two scenarios. In the first, someone borrows at a fixed rate to buy an asset that produces steady cash flow above that cost. Every month, the difference compounds quietly in their favor. In the second scenario, someone borrows without understanding returns or invests in assets that don't generate income, and the gap works against them every single month. Same tool, opposite outcomes. The difference is structure, not effort. This is why financial intelligence is not about avoiding debt or chasing high returns blindly. It's about controlling the spread with discipline. Because when the spread is positive, time becomes your ally. But when the spread is negative, time becomes your enemy. Every passing month either builds equity or erodes it. There is no neutral position. And here's where inflation enters the equation again. Inflation can either compress your spread or expand it, depending on what side of the system you're on. If your income and assets rise with inflation while your debt remains fixed, your spread improves over time. But if your income is stagnant while costs rise, your spread collapses silently. This is why the wealthy don't just think in terms of earning more. They think in terms of structuring smarter. They engineer situations where time, inflation, and leverage all work in their favor simultaneously. That is not luck. That is design. And if you're starting to see how these pieces connect, stay engaged, subscribe, and continue through the next part, because we're about to step into how banks evaluate risk and why they decide who gets access to leverage and who doesn't. Most people assume banks are in the business of lending money. That's not accurate. Banks are in the business of managing risk while preserving return. Lending is just the mechanism they use, but approval is never emotional, never random, and never based on your intentions. It is purely based on probability. Probability that you will repay. Probability that the asset will perform. Probability that their capital stays safe while generating a return. That is the real game behind the scenes. Now here's where things get interesting. Two people walk into a bank. One has enthusiasm, ideas, and urgency. The other has structure, clean credit history, stable income, reserves, and assets that already generate cash flow. The first person is hoping. The second person is predictable. And in banking, predictability is more valuable than ambition. Because banks don't reward potential, they reward stability. This is why credit score is not just a number. It is a behavioral history compressed into data. It tells the bank how you handle obligation under pressure. But that's only one layer. They also look at your debt-to-income ratio, liquidity position, and asset quality. Each layer reduces uncertainty. And the more uncertainty is reduced, the cheaper your access to capital becomes. That's the part most people miss. Interest rate is not fixed by the market alone. It is adjusted based on how risky you appear. So your financial structure directly controls your cost of money. Now think about this. If you can reduce perceived risk through better structure, you don't just get approved. You get better terms, longer duration, lower interest, higher flexibility. And that changes everything because small improvements in borrowing costs create massive differences in long-term outcomes. Over time, that difference compounds into entire wealth gaps between individuals who look financially similar at the surface. This is why the wealthy don't just build income. They build trust with capital providers. They position themselves as low-risk, high-quality borrowers so that banks compete to lend to them. And once that happens, the entire dynamic flips. You are no longer chasing capital. Capital is competing to enter your structure. If you're starting to see how power shifts through structure rather than effort alone, stay with this series, subscribe, and move into the next part, because next we break down how leverage turns into actual compounding wealth when deployed correctly. Most people think leverage is about borrowing money, but in reality, leverage is about multiplying outcomes without multiplying effort. That's the core distinction. Borrowing is just the surface mechanism. True leverage is what happens after the capital is deployed. And this is where wealth begins to separate from income. Income is linear. You work, you get paid. You stop, it stops. But leverage creates a break in that pattern. It allows one unit of effort to influence multiple units of return. Now imagine two people using leverage. The first borrows and spends. There is no return, only obligation. The second borrows and invests into an income-producing system, something that generates cash flow, appreciates in value, or scales over time. Both owe money, but only one is building a machine that pays it back. That difference is everything, because leverage does not reward action, it rewards correct direction. You can move fast in the wrong direction and still lose, or move carefully in the right direction and compound quietly for years. This is why structure matters more than speed. The wealthy don't rush leverage, they design it. They align borrowing cost with asset returns, ensure cash flow covers obligations, and build buffers so volatility doesn't break the system. That buffer is what separates controlled leverage from emotional leverage. Emotional leverage reacts to fear and greed. Controlled leverage reacts to numbers and structure. Now here's the deeper truth. Leverage amplifies whatever you already are. If your financial behavior is weak, leverage accelerates losses. If your structure is strong, leverage accelerates growth. It doesn't change direction, it multiplies it. That's why many people blame debt when the real issue is misalignment. The tool was never wrong, the deployment was. And once you understand this, you stop asking, should I use leverage? And start asking, is my structure strong enough to carry leverage safely? That is a completely different level of thinking. Because at that point, leverage is no longer a risk. It becomes a controlled system of acceleration. If this shift in thinking is starting to make sense, stay with it, subscribe, and continue, because next we go deeper into how compounding actually turns good leverage into exponential wealth over time. Most people underestimate compounding because they expect it to feel powerful early. But compounding is not dramatic in the beginning. It is almost invisible. That is exactly why most people abandon it. They don't see results fast enough, so they assume it's not working. But compounding doesn't reward impatience. It rewards consistency. And when leverage enters compounding, the effect becomes even more powerful, but only under one condition: positive spread. Imagine a simple structure. You borrow capital at a fixed cost and deploy it into an asset that generates consistent cash flow. That cash flow is reinvested, not consumed. Over time, each cycle increases your base. The next cycle is larger than the previous one, and that is where acceleration begins. Not from a single big move, but from repeated small reinvestments stacking on each other. Now contrast that with someone who uses leverage but withdraws profits for lifestyle upgrades. Their system resets constantly. There is no base growth, only short-term movement. That is why they feel busy but never see exponential results. Compounding requires retention. Nothing can compound if it is constantly extracted. This is also where time becomes a force multiplier. Early years feel slow because the base is small. But as the base grows, each percentage gain becomes significantly larger in absolute terms. That is the hidden curve most people never stay long enough to experience. Now, add leverage to this structure. If your borrowed capital is consistently producing returns above its cost, your reinvested profits are no longer just growing from your original capital. They're growing from both equity and borrowed amplification. That is where exponential behavior begins. But it only works if discipline holds. Because compounding is fragile in the early stages. One emotional decision, one withdrawal, one bad investment, one overextension can reset years of progress. That is why the wealthy treat early compounding phases with extreme respect. They don't try to impress the system. They let the system build itself. And over time, something powerful happens. Income stops feeling like effort and starts feeling like structure. Money begins to flow through systems instead of labor. If you understand this principle, you stop chasing quick wins and start protecting long-term cycles. And if you're serious about seeing how this builds into full financial systems, stay consistent, subscribe, and continue. Because next we go into how diversification protects everything you've built from collapse. Most people think diversification is about owning more things. But real diversification is not expansion. It's protection through structure. There is a big difference between having many assets and having uncorrelated assets. One creates confusion, the other creates stability. And this difference becomes critical when leverage is involved. Because leverage reduces your margin for error. It increases both upside and downside. So if everything you own behaves the same way in a downturn, you are not diversified. You are concentrated with extra risk layered on top. Now imagine someone who builds wealth in one area only, like real estate in a single city. When that market rises, everything feels strong. Cash flow improves, equity grows, confidence increases. But when that market slows, everything weakens at once. Vacancy rises, values drop, liquidity tightens. That is concentration risk hidden behind success. Now contrast that with someone who spreads exposure across different drivers. Real estate in different markets, a business with scalable income, and investments that respond differently to economic cycles. When one area slows, another stabilizes or even grows. That balance creates resilience. And resilience is what allows leverage to survive volatility. Because the real danger in leverage is not normal market movement. It is synchronized stress across all your positions at the same time. That is what destroys systems. So diversification is not about randomness. It is about reducing correlation between income streams and risk sources. But here is the deeper mistake most people make. They diversify too early and too thin. They spread capital across too many weak positions and never build mastery in any of them. That creates fragility disguised as safety. Real diversification comes after competence. First, you build one strong, stable, predictable engine. Then you expand into adjacent systems that behave differently under pressure. That way, you are not guessing. You're building layers of protection around a strong core. And when leverage enters this structure, it becomes far more stable, because even if one area contracts, others absorb the pressure. This is how wealth survives cycles instead of collapsing during them. If this idea is starting to change how you think about risk and structure, stay with this series, subscribe, and continue, because next we move into timing and why most people lose money not because of what they buy, but because of when they build their structure. Most people believe success in investing comes from finding the right opportunity. But in reality, it often comes from understanding timing, specifically timing your structure, not just timing the market. This is where most investors get trapped. They wait for perfect conditions, low interest rates, rising markets, stable economies, and clear signals. But those conditions rarely arrive all at once. And by the time everything looks perfect, the best opportunities have already been taken. Now here's the deeper truth. Markets move in cycles, but wealth is built by positioning yourself correctly within those cycles. Expansion, peak, contraction, recovery. These phases always repeat. The difference is not whether they happen, but how prepared you are when they do. During expansion, credit is easy and optimism is high. Many people overextend because everything feels safe. During peaks, confidence turns into assumption. People believe conditions will continue forever. That is usually the most dangerous stage. Then contraction arrives, and suddenly liquidity tightens, prices adjust, and fear spreads. This is where unprepared leverage breaks. But for those who structured properly, this is where opportunity appears. Because when others are forced to exit, assets become mispriced. Then comes recovery, where early positioning is rewarded most. Now notice something important. None of these phases can be predicted perfectly, but they can be prepared for structurally. That means your leverage terms, liquidity reserves, and asset selection should be built to survive multiple conditions, not just one ideal scenario. This is why professionals don't ask, when should I enter? They ask, does this structure survive if conditions change against me? That shift alone prevents most financial mistakes. Because timing the market is emotional, but timing your structure is mathematical. If your cash flow works under conservative assumptions, if your debt is manageable even under stress, and if your reserves can absorb volatility, then timing becomes less important. You are no longer betting on conditions. You are building resilience into your position. And when structure is strong, you don't need perfect timing. You can act when opportunity appears, not when fear disappears. That is the real advantage. If this concept is shifting your thinking about risk and opportunity, stay with it, subscribe, and continue, because next we move into how systems are built so income no longer depends on your personal effort. Most people spend their entire financial life trying to increase income, but they never stop to question whether their income depends too heavily on their time. And that is the hidden limitation most never escape. Because time is fixed. You can work more efficiently, you can increase rates, you can improve skills, but you cannot expand time itself. So if your income is tied directly to your hours, there will always be a ceiling. Now here is where systems change everything. A system is anything that continues producing output without requiring your constant presence. It could be a rental property, a business with management structure, or a digital product that sells repeatedly. The key difference is separation between effort and outcome. Once that separation exists, leverage becomes far more powerful because borrowed capital is no longer just amplifying your labor. It is amplifying system. And systems scale in a way personal effort never can. Now, imagine two individuals again. One works harder every year, increasing income slowly but remaining tied to daily effort. The other builds a system that initially requires work, but over time becomes structured, delegated, and automated. Eventually, that system produces income even when they are not actively involved. The The first person is trading time for money repeatedly. The second is designing machines that produce money. This is where financial independence begins to evolve into something deeper, structural independence. Because once systems exist, your decisions shift. You stop asking, how much can I earn this month? And start asking, how can I improve the output of my systems? That is a completely different mindset. And when leverage enters this environment, it no longer feels like pressure. It becomes acceleration for something already working. Instead of borrowing to create income from zero, you are borrowing to scale something that already performs. That is where risk decreases and efficiency increases at the same time. But systems only work when they are maintained. Neglect breaks systems slowly. That's why wealthy individuals don't disappear from their assets. They shift from operators to overseers. They monitor, optimize, and adjust rather than execute everything manually. And over time, this creates a powerful shift. Income becomes less about effort and more about design. If this idea is starting to reshape how you view work, money, and freedom, stay consistent, subscribe, and continue. Because next we move into how true financial sovereignty looks when systems, leverage, and structure finally align. Most people chase financial independence, but very few ever reach financial sovereignty, and the difference between the two is subtle but life-changing. Financial independence means your income covers your expenses. Financial sovereignty means your structure protects your freedom regardless of conditions. That means even if markets shift, interest rates rise, or income slows temporarily, your system does not collapse. It holds. That stability comes from design, not luck. Now think about what that actually requires. It requires diversified income streams, controlled leverage, strong reserves, and assets that behave differently under pressure. It requires removing dependency on any single source of income or any single market condition. Because dependence is where vulnerability begins. Most people think freedom is about making more money, but true freedom is about reducing fragility. If one event can destabilize your entire financial life, you're not free, you are exposed. Sovereignty begins when your system can absorb shocks without forcing panic decisions. That means you don't sell assets in fear, you don't borrow under pressure, and you don't depend on perfect conditions to stay stable. Instead, your structure is built to adapt. Now here is the deeper shift. Sovereign investors don't react to the economy, they position within it. When conditions are strong, they expand carefully. When conditions are weak, they acquire strategically. They are not emotionally tied to cycles because their system is designed to survive all of them. And leverage, in this stage, is no longer about expansion at all costs. It becomes a precision tool used only when it improves structure. That is the final evolution of leverage. Not dependence, not aggression, but control. Because once you reach sovereignty, the goal is no longer growth for survival. It is stability with optional growth. And that changes every financial decision you make. If this shift is starting to make sense, stay with it, subscribe, and continue. Because next we move into integration, where all these concepts combine into a single system of financial control. Most people try to understand money in pieces, debt, income, investing, saving, as if they're separate topics. But in reality, wealth is not built in fragments. It is built through integration. And integration means all financial decisions must connect into one system that supports the same goal: stability, growth, and control. Without integration, even good decisions can cancel each other out. You might invest well, but borrow poorly. You might earn a high income, but have no structure to protect it. You might save aggressively, but never deploy capital effectively. Individually, these actions look responsible. Together, they may still fail to create wealth. Now, imagine a different approach. Every financial move is designed to reinforce the others. Debt is used only when it improves asset growth. Assets are chosen based on their ability to produce or appreciate. Income is structured to feed reinvestment. Expenses are controlled not emotionally, but strategically. Liquidity is maintained to protect against volatility. Everything works together like one system instead of isolated decisions. That is integration. And once integration exists, leverage becomes far more powerful because it is no longer acting on scattered pieces. It is amplifying a coordinated structure. This is why some people borrow and struggle, while others borrow and accelerate rapidly. The difference is not the loan. It is the system behind the loan. Now here's the deeper insight. Integration also protects psychology. When your finances are disorganized, every problem feels personal and urgent. But when your system is structured, problems become adjustments, not crises. A vacancy is not a disaster. It is a temporary variable. A rate increase is not collapse. It is a recalibration. That emotional stability is a hidden form of wealth most people never experience. Because when your system is integrated, your mind becomes calmer. And calm decision-making produces better financial outcomes over time. Wealth is not just about numbers. It is about coherence. If your money, debt, assets, and decisions are aligned, you stop fighting your own structure and start refining it. That is when progress becomes consistent instead of chaotic. If this idea is connecting the dots for you, stay with it, subscribe, and continue, because next we move into how discipline becomes the invisible force that holds everything together when markets and emotions fluctuate. Most people believe discipline is about restriction, but in wealth building, discipline is actually about protection. It protects your system from emotional decisions that quietly destroy long-term progress. Because the real threat to wealth is not lack of opportunity. It is inconsistency in behavior. You can have the right strategy, the right leverage, and the right assets, but without discipline, everything becomes unstable over time. Now think about how wealth actually breaks down in real life. It rarely collapses in one moment. It erodes slowly through small compromises, withdrawing profits too early, overextending on lifestyle, ignoring reserves, or taking unnecessary risks when emotions are high. Each decision feels small in isolation, but together they weaken the structure. That is why discipline is not dramatic. It is repetitive. It is doing the same correct actions long enough for compounding to work. Now imagine two investors again. One reacts to emotions. When profits rise, they spend more. When markets fall, they panic and adjust poorly. Their behavior changes with conditions. The other maintains a fixed process. They reinvest consistently, maintain liquidity, and only adjust based on structure, not emotion. Over time, the difference between them becomes massive, not because one is smarter, but because one is consistent. This is where discipline becomes invisible leverage. It stabilizes decisions long enough for compounding to build momentum. And once momentum exists, wealth begins to feel self-sustaining. But discipline is tested most when things are going well, not when they are struggling. Success creates temptation. It creates the illusion that rules can be relaxed. That is where most systems start to break, not in crisis, but in comfort. So discipline is not about punishment. It is about preserving structure when emotions try to interfere. And when combined with leverage, discipline becomes even more critical, because leverage magnifies both gains and mistakes. That means every undisciplined decision is amplified, not absorbed. If this idea is changing how you think about control and consistency, stay with it, subscribe, and continue. Because next we move into how risk is actually measured by professionals and why perception of risk is often more important than risk itself. Most people think risk is something you either avoid or accept, but in professional finance, risk is something you measure, structure, and manage, not eliminate. Because in reality, every financial decision carries risk. Saving has risk, investing has risk, borrowing has risk, and even doing nothing has risk. The difference is not whether risk exists, but whether it is controlled or uncontrolled. Now here's the key insight. Risk is often less about the asset itself and more about how it's structured. Two people can own the same investment, but experience completely different levels of risk depending on leverage, timing, and liquidity. One may feel constant pressure, while the other remains stable under the same market conditions. That difference comes from structure, not luck. Now imagine someone using leverage without understanding risk alignment. They borrow aggressively during expansion, assume stability will continue, and ignore liquidity buffers. When conditions shift, the pressure multiplies quickly, not because the asset failed, but because the structure had no room for adjustment. On the other hand, a structured investor approaches risk differently. They stress test outcomes. They assume worst-case scenarios. They ensure cash flow can survive volatility. They maintain reserves that absorb shocks instead of reacting to them. That is what transforms risk from threat into manageable variability. And here is where perception becomes powerful. Markets don't just move based on fundamentals. They move based on fear and confidence. That means even strong assets can experience temporary instability if sentiment shifts. A structured investor understands this and does not react emotionally. They know that volatility is not destruction. It is fluctuation within a larger system. Now here's the deeper truth. Leverage does not increase risk by default. It exposes risk that already exists. If your structure is weak, leverage reveals it faster. If your structure is strong, leverage amplifies it positively. That is why professionals don't avoid leverage. They refine exposure. They ensure that even under stress, the system holds. Because true risk management is not about avoiding movement. It is about surviving movement without losing control. If this is changing how you see uncertainty and decision-making, stay with it, subscribe, and continue. Because next we move into how credit becomes a reputation system and why banks treat behavior as more important than income alone. What ultimately separates financial struggle from financial control is not access to information, but consistency in applying structure under changing conditions. Everything discussed so far, leverage, systems, timing, diversification, discipline, and risk, only works when they're treated as parts of one continuous framework rather than isolated ideas. Wealth is not built through isolated wins. It is built through repeatable behavior that holds up across cycles. As your structure matures, the focus gradually shifts. Early on, the goal is acquisition, building assets, and establishing income streams. Later, it becomes optimization, refining returns, reducing friction, and improving efficiency. Eventually, it becomes preservation and control, ensuring that what you've built does not become vulnerable to volatility, emotional decisions, or overexposure. This progression is where financial maturity actually develops. At the highest level, leverage is no longer about expansion, but about precision. Debt is used selectively, only when it strengthens structure rather than stretches it. Capital is allocated based on clarity, not urgency. And decisions are made from position, not pressure. That shift alone changes outcomes more than any single investment ever could. The real goal is not constant growth at all costs, but stability that can support growth when conditions are favorable and hold firm when they are not. When your financial system reaches that level of coherence, external noise loses its power. Markets still move, cycles still change, but your structure remains intact because it is designed for variability, not certainty. At that point, finance stops being reactive and becomes strategic by default. Every decision reinforces the system instead of disrupting it. And that is where long-term control is actually achieved, not through prediction, but through preparation that never stops adapting. This concludes the framework. At this stage, everything starts to come together into one final realization. Wealth is not built through isolated tactics, but through a continuously evolving structure that adapts while staying disciplined at its core. The earlier phases were about learning how each component works: debt, leverage, assets, systems, timing, and risk. But now the focus shifts toward how all of it behaves as a single living framework over time. Because in reality, financial progress is never linear. There are periods of acceleration, periods of stagnation, and periods where nothing seems to move at all. And this is where most people misinterpret the process. They assume lack of visible growth means failure, when in fact it is often consolidation, where systems are strengthening beneath the surface. Equity builds quietly, experience compounds, and structure becomes more stable even when external outcomes feel unchanged. The real advantage of understanding this framework is that it removes emotional reaction from financial decision-making. Instead of responding to short-term outcomes, decisions begin to be evaluated based on long-term structural impact. Does this improve cash flow stability? Does this reduce dependency? Does this strengthen resilience under stress? These questions replace urgency, and urgency is often what leads to poor financial positioning. Over time, the goal is not to eliminate complexity, but to control it, because complexity exists in every financial system. The difference is whether that complexity is chaotic or organized. When organized, complexity becomes strength. Multiple income streams, layered protections, diversified exposures, and controlled leverage all working together instead of against each other. At this level, financial thinking becomes less about chasing opportunities and more about refining structure. Small improvements in efficiency, cost of capital, allocation, and risk exposure begin to produce significant long-term effects. That is the quiet power of compounding systems. They reward patience, discipline, and consistency far more than intensity. And eventually, the outcome is not just financial growth, but financial stability that does not require constant intervention. A system that operates with resilience, adapts to cycles, and continues to function without emotional disruption. This is where the entire framework naturally leads. At this point, everything you've explored starts to converge into a single principle. Control is built, not found. It is not something granted by markets, banks, or timing. It is something constructed through repetition, discipline, and structure that holds under pressure. When you zoom out far enough, financial outcomes are less about individual decisions and more about the system those decisions belong to. One strong decision inside a weak structure still produces instability. But a structured system can absorb imperfect decisions and still remain stable over time. That is the difference between fragility and resilience. This is why long-term financial progress is rarely about dramatic moves. It is about alignment, ensuring that income, leverage, assets, liquidity, and risk all point in the same direction. When they don't, even strong income can leak away through inefficiency. When they do, even moderate income can build lasting wealth. And as this structure matures, something important happens. Emotional dependency on outcomes begins to fade. You stop reacting to short-term fluctuations because you understand the role they play in a larger cycle. Gains are not celebrations. Losses are not disasters. They are simply movements within a system designed to handle both. At the highest level, the goal is not to predict every shift in the economy, but to remain functional and positioned regardless of what shifts occur. That is what turns finance from stress into strategy. Not perfection, but durability. Not certainty, but control under uncertainty. If you've followed this far, you've already moved from thinking in transactions to thinking in systems. And that shift alone is where real financial transformation begins. If you made it this far, you've already done more than most people who start learning about money. You've started thinking in systems instead of moments, structure instead of emotion, and long-term positioning instead of short-term reactions. The difference now isn't knowledge, it's application. Because everything you've heard only becomes real when it shows up in your decisions. How you handle debt, how you allocate income, how you respond to opportunity, and how consistently you protect your structure when emotions try to interfere. Wealth is never built in one breakthrough. It is built in repeated alignment over time. So don't just move on from this. Use it. Revisit it when decisions feel unclear. Apply it when pressure shows up. Refine it as your situation changes. If this series added value to how you think, subscribe so you don't miss the next breakdowns, and comment what idea shifted your perspective the most, because that's where real learning turns into direction. And remember, financial control is not a destination. It is a system you keep improving,